Another corporate voice joining in on the show right now, and we have Mr. B Ramesh Babu. He's the MD and CEO at Karur Vysya Bank, here to talk a little bit more about the term extension as well as the outlook on the financials. Thanks so much for taking time out. Congratulations on the appointment. But I wanted to get started off by talking a little bit about Karur Vysya Bank's financials, in particular the margins, because across the banking system, we've seen a contraction. What is it that you're looking at when it comes to margins for Karur Vysya?
First
Yes, sir.
of all, good morning and thank you. This is a wonderful quarter if you look at this quarter, because both on the business front as well as the profitability, we did very well. If you look at our profit, 2 years back in 2021, the whole year profit was 359 crore. Whereas if you look at this first quarter, the quarter profit is 359 crore. So this has come on account of many levers which we have worked. It is on account of the business growth. Comfortably we are growing, which used to be in single digit, now it has moved to double digit, and every vertical is contributing for that. Asset quality, most benign quality. In fact, the SMA is 30 plus is below 1%, and the net NPA is at 0.59%, gross NPA is below 2. All these things are allowing us to have a good profitability. If you look at our NIMs also, it is 4.19. So we guided in the month of May for the March quarter results when we were talking. So we said that both the quarters 1 and 2, we will be above 4. So it actually aided by two things. Though our cost of deposits has gone up by 35 basis points, the yield also supported by 14 basis points. One of the advantages the bank has is 47% of our advances portfolio is still MCR linked. Agreed? Last year it was 57, it has come down by 10%, but still we have some more room left over for the MCLR repricing. So that way we feel next quarter also we will be able to maintain the same trend.
Okay. Let's understand the impact of high interest rates. In the first leg of an high interest rate environment, banks, they have higher NIMs. But now that interest rates are peaking out, do you think your NIMs will come under pressure?
Absolutely, because you see last 3-4 quarters, if you see, it has come down, and we also estimated the same way. If you look at our this quarter, it has come down by 35 basis points over the March. Not in the sense that not the NIMs. Cost of deposits has gone up, so NIM has come down by 10 basis points, but still it will come down. But still we will be able to maintain above 4% for the next quarter, because it's a two-pronged approach we are doing. We are gauging the inflow of the deposits. Wherever the flow is good, actually in few of the cases we have reduced the rate of interest also for the few buckets. So that is reducing our cost of deposits, and we have invested some heavily on the feet on street for the CASA acquisition and the retail sales. So this is going to help us in the days to come. So that will further reduce the cost of deposits. Other side on the yield, what we are doing, the low yielding advances whichever are there, we are trying to get out of that. We are engaging with them. If they can improve the yields, well and good. Otherwise, the risk reward ratio is not matching. We are willing to get out a few of them. That is the reason you could find that the corporate growth is only 2% this quarter. Ideally, had we compromised on the yields, it would have gone to 15%. That is not an issue. So that way, it is a multi-pronged approach we have been taking, both on the yield fronts as well as the cost. So to protect our NIM, but whatever it is, next quarter we will be able to have a clarity on third and fourth quarter where we will be.
Your deposit growth. Do you think that you can sustain the sequential deposit growth that you have been clocking in so far?
No, this quarter it's a quarter on quarter is 5% is, but whatever it is overall we have planned for a 14% growth, because advances we are planning to grow at 14, more or less at the same rate if you are able to grow. So we'll be able to maintain here and there the CD ratio, and we'll be able to maintain, not an issue. So as against that 14% what we have planned, so on an annualized basis, if you look at this 5%, it comes to around 20%. Even if in subsequent quarters if it comes down also, it will not matter much to meet our advances growth, what all is required. So we'll carefully gauge and we look at it. Wherever the requirement is not there, we may have to reduce the deposit rates. So that may involve some sort of a reduction in the flow. But overall, the bottom line will be improving. So that way, in a calibrated way, we'll go for that. So though we will not aim for 20% of the deposit, we will look at what is needed and all. If you are able to make money out of the deposit, what we are getting it, we will definitely go for that.
Right. On the loan growth side as well, I wanted to understand because Q1 has been very strong in a seasonally weak quarter for you. What trends are you seeing, and what is your full year target and guidance then, now that you have a strong quarter at the back?
I agree with you. So we estimated around 14%. So because that has to come. Now, what amount of corporate loans still we will get out of that? I am not clear yet, because we are engaging with few of the big corporates where the yields are pretty low. If they are not going to yield for the yields, so naturally we may have to get out of that. So that way, I think overall between 14 and 16 in this range we may be able to grow. So one thing we want to understand, so aggressive growth at this stage when you are relatively comfortable, so will make you jittery. So our intention is the growth has to be safe and the asset quality should not be there. Both should result in a proper profitability. So we will look at a point, if we can reach a decent point where we can take to the next level, so we will take it from there. From now onwards, at least we'll think that to maintain the existing setup and all, and 14 to 16% we will grow, and later we will take a call on that for the next phase.
Right. Is there a specific loan mix that you're targeting as well for the bank?
Yeah, absolutely. If you look at it, ours is a majority is a SME focused bank. So last 3, 4 years, if you look at it, our 33% of the portfolio is from the commercial. So which we call SME is majority goes to the commercial. So next is around 22% we maintain in retail. So that can go up to 25. So earlier we were maintaining around 30, 35% for the corporate, which has come down drastically now to 21%. So that has been taken over by the agriculture. Agriculture has gone up. So why we felt agriculture is one of the good areas is the area of operation where we are working, there's a lot of scope for agriculture. And above all, this is a majority is a gold belt. So people are inclined to pledge their gold. So that way, a lot of growth comes in the gold loans, which is relatively safer on one front. There is no capital cost for this. And above all, so it accounts for the agriculture for the priority sector. With all these things, we focused on the gold. But whatever it is, if you can look at our presentation, so last 3 years, more or less, our gold loan is at 25% of the overall portfolio. That's why we don't want any concentration risk in any other product as well as the portfolio. If you look at it overall that way, around 80% of the portfolio is RAM, retail, agriculture, and MSME, and 20% is around corporate. So we will try to contain these levels more or less, and focus will be on these three segments because the yields are relatively better here compared to corporate.
Sure. Your credit costs also have fallen. PCR seems to have risen. You seem very well covered. Where do you then see risks or concerns at all for your book currently?
No, it is not the question of risks and concerns. You see, this year we made a provision of 25 crores floating provision also, because what we felt is when the good times are there, so you need to think of a probable bad time which may come up. Otherwise, if you think today everything is rosy and all and hunky dory, it will continue like this. So we may be at fault because the impending catastrophe we may not be knowing, but there may be catastrophes in the future. So that is the reason what we thought continuously we have been uh, improving our PCR and the floating rate. These sort of things we are doing so that any eventuality tomorrow comes up, so we will be able to absorb the shock without any hassle, because we have come after a great journey to this stage now, and now more or less every parameter what you can conceive, so we are able to tick the boxes and all. So from now onwards, the challenge is how we are going to sustain. I know very well it's a stimulating challenge, but whatever it is an important for us to see that what all we have gained, we should not lose.
All right. And what part of your book is secured? Can you give us a sense? Because even your cost to income ratio has gone up. What has caused this increase? And where can we see that shaping up in the near term?
Yeah, there are two questions regarding the secured book. If you look at it, our unsecured, which people call usually for a personal loans and credit cards, all these things will be is around 1.85%, which is below 2%. So though we have made a small entry into MFI segment, with a very good established partner to take it forward, because we will not have the wherewithal to directly handle these sort of things. With an established partner, we started few months back, and we could get a portfolio of around 55 crores in that now. And likewise, the personal loan front also, we have a very good arrangement with Amazon BNPL. So where we have lakhs of customers with our partner. So the partners, what we have, the customers whom we have acquired for the last 3-4 years, we are mulling on that through analytics. We are trying to get out who are good. So whether we can extend these unsecured loans to them, that is in an advanced stage. Once we get that, we may go up to 5% for the unsecured book to start with. Coming to the cost to income ratio, if you can look at our past, it used to be 50%. Many quarters, it used to be above 50%. So we have brought it down, and last quarter was 42, and this quarter is 47. There are a variety of reasons for this. This year, what we did, the ex gratia, what we pay annually, last year it was in the second quarter, this we made it in the first quarter this year. So in addition to that, as I was mentioning, we have invested a lot on the retail liability sales. We have acquired the people, around 905 people we have taken from the market from different banks who are absolutely oriented towards the sales. So this will go up to 1300. So we have different verticals under that. It can be corporate, trade, retail, salary package, all these. We have started that. It is in a formative stage now. Once these people they come up, I agree initially we are making an investment. This will help us in different ways. First thing on acquiring a low cost deposit, and second thing is to cross sell, and third thing is to get asset leads from these teams. So that is the reason what we thought. When the things are good, you need to invest something on the future. Otherwise, future will be bleak. So whatever it is, we have guided that our cost to income ratio will be around between 45 and 50. So we are at the midpoint. So we will be doing it. But every rupee what we are spending now is for the future, and it's an investment, not an expense.
I wanted to talk about, your deposit costs as you focus more on deposit growth, because your deposit cost has been lower as compared to your peers. Do you believe that this is going to perhaps move closer to what your peers have been clocking as an average?
Uh, no, abruptly it may not move, because our rates are still more or less competitive. So we know it, the savings bank interest rates also. So we have not changed it, because we found from a back of an envelope calculation that, so even if we change the rate of interest on savings bank, it is not elastic actually. The inflow is not matching with the cost we are going to incur. So there is another downside for that is, if we increase the savings bank interest rate, the existing portfolio gets repriced rate. So the cost will have to pay across the board immediately, whereas the benefit may not be there. So that is one area which is helping us. And second thing is, so the cost of deposits, we will see the market, and what bare minimum we'll require, we'll keep it. If you look at our portfolio also, 80% of the portfolio is retail. That is households. Majority of them are households, self-employed. Such a granular portfolio we have. So these people are not agnostic to the rate of interest. The relationship what we maintain with them, that matters a lot. The great thing about the organization is the culture. The organization culture, the way they maintain the relationship with the customers. Many people for the generations they are dealing with the bank. That is helping us even in the deposit accretion also, by paying a more or less a decent rate of ratio interest rate, and still able to get the deposits.
Good to have you on board. Thanks so much for joining in and giving us those latest details. That's the management speaking to
Thank you
ET
very much.
now, talking about how they are looking at around 80% of their overall portfolio RAM, and they are looking to grow in the band of about 14 to 16% as of now. A 14% growth on deposit is what is expected.